Is Bitcoin on the cusp of a pre-halving retrace? We've seen it in 2019. Can we see it again? We've seen 23% downside in 2015, 38% downside in 2019. Could we see something quite similar? Because from lower high to higher low, we just need 32% downside. We're going to be talking about that in more detail in today's episode. So subscribe to the channel, like this video if you enjoy videos like this, and let's dive right into it. So for a rejection from lower high to macro higher low, it's only 32%. But time is a factor. And we're going to be talking about that in this episode because right now, actually, it is around 30% downside from lower high to higher low. But next month, in November, it's going to be a different story because that's going to turn into a 30% retrace from where the price point of the lower high is going to be 27,600 and the higher low is going to be 19,400. But what about in December? We can see that from 29% to 26%, it drastically changes, doesn't it, with time? The higher low is increasing in terms of the price points it's representing every single month. And the same goes for the lower high, but the price points are declining. So at the same point, we're seeing a retracement depth shrink. So this is really December, 26% from lower high to higher low. In January 2024, it's going to shrink even more from 23%. And then if we actually see a retracement from lower high to higher low in February 2024, that's going to be a 19% retracement. So you can see here that over time, if we just focus on retracement depth with each passing month, if we were to see a retracement right now in just 1 month all at once, a 30% crash would get us to the higher low. But next month, November, 29, 30%, December, 26%, 23% in January, and 19.5% in February 2024. But the key takeaway here is that we're going to be hovering around the 19K to 20K region at the higher low. So the higher low isn't going to really change that much over time. But we see a bit more of a slant in terms of the lower high. It's more of a slanting lower high, a resistance changing by 1,000, roughly speaking, every single time, maybe even a little bit less. But the main key takeaway here is that this is the lower high that we really need to be watching out for. We tend to FOMO wick, upside wick, beyond this lower high resistance quite a lot. And if we can't hold these bull market exponential moving averages as a support, we're going to have to revisit this 26K region. And historically speaking, we don't tend to hold above these EMAs quite well in a pre-halving year. So maybe we can hold here, maybe even for a few weeks, but history suggests that we might actually lose them as a support. And that's something really to focus on because historically we don't see much stability right over here. So at this same point in the cycle, in 2015, 200 days before the halving, we saw a 24% crash. At this same point in the cycle, in 2019, we saw a 38% crash. So at this same point in the cycle, whether you're comparing 2023 to 2019 or we're comparing it to 2015, the main takeaway here is that a retrace between 24% to 38% could occur also in this cycle. And of course, we'd need a 32% retrace or 30% roughly speaking to get us to the macro higher low. But if we just continue to slow bleed around this lower high, then this could really just change over time. It could really change over time in terms of the retrace depth. Maybe it could be 23% at some point in the future, maybe 19%. But generally speaking, this next 140-day period is going to be absolutely crucial because while it's less than 200 days until the halving, historically speaking, we've seen that in the 5 months ahead right now, analogous to 2019, the 5 months roughly speaking is when we tend to see lots of volatility towards the upside, the downside, but also a revisit of the higher low. So in the next 140 days, that's where, if we see a crash, it should be during this time period. Because just about a month or two before the halving is where we're going to actually reverse and go towards the upside. So after that 140-day period, we might revisit the macro higher low. That could be 19 to 20k, and then a reversal towards the upside going into the halving. And you can see that the closer we get to the halving, the more hype there is around this halving. People buy the hype and they sell the news in the short term, but inevitably we continue into post-halving price continuation in a parabolic fashion. So the key here is maybe there is going to be a bit of a retrace over the coming 5 months. That's the last chance at a crash, and it's going to be the last time ever that we see the low 20k or even sub 20k region. In this next 140-day period, we're going to see the 20k region for the very last time before we break to new all-time highs and discover price action like we've never really discovered it before. So if we just think about that for a second and bear in mind that we're not going to see those prices ever again, and it's no given that we're going to see a crash in this period, but if a crash does happen, it would be within this 140-day period. It would be the last time we see 20k before finally reversing into an uptrend and then rallying to new all-time highs after the halving, like we've seen in the past. Because if we just look at every single cycle after the halving, we've seen some stuttering in the red post-halving resistance area, but inevitably growing into new all-time highs. Same thing post-2019, stuttering at the post-halving resistance and then rallying into a parabolic uptrend. And the same thing is probably going to be later in the cycle after the halving. So don't get shaken out. Be prepared to potentially dollar cost average into your Bitcoin position as we decline, should we indeed decline. And if now is really the time for a retrace to happen, because if it doesn't, then it's going to be quite complicated to find a good entry going into the halving. But history is suggesting that this is the time, the pre-halving period, the next 5 to 6 months, that's going to be the time to see a bit of a deeper crash. So that crash could be minus 24% like we saw in 2015 to 38% like we saw in 2019. Could we see that in this cycle in preparation for the post-halving rally that still lies ahead? Don't get shaken out. Dollar cost average, use this pre-halving period to prepare for the post-halving rally that will inevitably emerge in a few months' time, many months down the line. Subscribe to the channel for more videos like this in the future. Like this video if you enjoyed this one, and feel free to check out my video in the top right hand corner for more insights and analysis. Thank you so much for watching today, and I'll speak to you in the next one.